rate policy that came out yesterday talked about, well, actually nothing much because interest rates have not been changed. Now, interestingly enough, this is the third policy review that there are no change in interest rates. Now, people are expecting interest rates, of course, to go down. Now, in September 2013 and between September 2013 and Jan 2014, the Reserve Bank or the Central Bank of India actually raised interest rates by 75 basis points, and which is 25 basis points on each occasion. So the largest signal seems to be that interest rates do not look like they're going to come down in a hurry. Now, the question that we are asking today is, does this all mean that you can actually afford to buy the house that you want? Or in a larger sense, are you in a position, or should you be in a position to be investing or saving in assets or otherwise at this point of time? Joining me to answer that very tricky question in some ways is Gaurav Mashruvala, financial planner, Karthik Javeri, also a financial planner of Transcend, and Shogata Bhattacharya, chief economist of Axis Bank, will be joining us shortly. So, Gaurav, the question that we're asking is, what does this mean to me as an individual, whether I'm a saver or an investor? Take us through how one should, if at all, interpret the Reserve Bank's signals as of yet.
So at an individual level, there is not going to be any drastic change. For quite some time, the interest rates have been stable. Now, obviously, RBI or central bank has a concern and inflation is a concern. So they are not saying that inflation has come in control and hence let's start reducing the interest rates and kind of ensure that home loans become cheaper and whatever. So that's not happening. It's not more money for people to spend. But at the same time, it's not that they are overly cautious and saying it's going to go up and, we are really, really concerned. So for a common man, for a consumer, it's a status quo. If you need to purchase house, you can't be continuing staying in rented premises because you're expecting some rate of interest to drop. Go ahead and do it. If you wanted to open a fixed deposit, do it because you'll still get a higher rate of interest. So if you're a saver, you're benefiting. If you're a borrower, if you need to, go ahead and pick it up.
Okay. So the overall basket, I mean, if you look at when I say basket, I mean the interest rate factor, the inflation factor, and let's say my individual propensity and my desire to acquire or buy something at this point. If you were to put all of this together, has this changed at all in the last year or so, or couple years?
Not drastically. Right. So interest rates remaining same. There has not been any changes, and that it's not that your fixed deposits are giving you lesser rate or rates have gone up. Similarly, when you're taking a mortgage, when you're taking a home loan, it's not you're either paying more or you're paying less. So for you, it's a status quo. There isn't any change based on the changes in the credit situation in the economy per se. There isn't any change that has happened.
Right. Okay. So let's put this question to Karthik as well. Karthik, how are you seeing? I mean, just walk us through the environment as you see it today, and we'll subsequently talk about what should people be doing at this point of time.
I'm quite in agreement with Gaurav. Prima facie, a lot of things hasn't changed. Financially speaking, if somebody had to make an investment into a fixed interest instrument, the time is now. It's a good idea. I personally think that going forward, you will see announcements from the RBI which will actually start cutting rates, which means if someone is a fixed deposit investor, of course, he's going to get his rate because going forward, the rate will fall. If somebody wants to go to fixed income via the bond market route or via bond mutual funds, that's also a good idea because not only will the coupon come to you, but also what will happen is you will have the chance of earning some good capital gains on that bond investment. Coming to the borrowing side of things, if you have to borrow and if it's your first property, I'm always of the opinion that any time is a good time. At the same time, you should not be locking yourself into a fixed home loan kind of a scenario. You should be in what they call as a full floating rate scenario. So if you're in a floating rate loan, what will happen going forward is as the rates go down, you will get the benefit of having a floating rate advantage to yourself. So that's probably the way you should think about lending. If you have to buy something through a personal loan or through a car loan, if that can be pushed a little bit behind, maybe wait for a rate cut. But if you really need it, I mean, in any case, just go and do it. If you're going to prepay, then I think just hold on to your money for a little while. If you can invest it wisely, in the next couple of years, with the interest rates going down, I think there's going to be a lot of profit which you will get an opportunity to make in the stock market, and you might want to use those profits to then make a payment. So there's lots of things that you can do.
Right. So Karthik, let me, and I'm going to come to Gaurav with this as well. So if I had 100 rupees today, okay, we'll create a separate scenario for tomorrow. But today, if I had 100 rupees, how should I be distributing it?
Right, with everything else put away, I mean, if you are young, I would think if you are anything less than about 50, 55, then you've obviously got 5 to 10 years for retirement. Therefore, I would say, go away, put about at least 60-65% of your money in the equity markets. This is obviously not giving consideration to any goal, and all we are trying to do is create wealth. So that's a little disclaimer. And the remaining money, I would think that you can put into bond funds. And when you put it into bond funds, park for more than a 3-year time frame. Because if you have anything less than that, now of course you don't have a choice. Go to liquid funds or shorter FDs. But otherwise, the remaining 40% of your money, if you put into long-term bond funds, there's great chance that you will earn about 8 to 9% with virtually low or zero tax, because you will have the benefit of indexation, and you will still earn your 9% versus making a fixed deposit where you're going to earn about whatever, same 9%, but you'll have to pay 30% tax. So that's the differentiation you want to do.
You're saying 60% equity, 40% bonds, and if someone were debating between should I buy as a fixed immovable asset at this point versus doing all of this, what would you suggest?
Well, allocate 60%. Stock market and the real estate market, which tend to give the similar sort of return in terms of growth basis over a very long kind of a period. So if you take a research based on 15, 20, 25 years, then you will see that both real estate and the stock market are in the range of about 15 to 18% on a compounded basis year on year, which means they are almost the same. So if you have to buy a real estate, let's say, then maybe put 30 rupees of your money into real estate and the other 30 into equity, or however you prefer. But my formula generally is go 1 to 1, which means if you put 1 rupee into a real estate, you should have minimum 1 rupee into something which is non-real estate, because that means you'll be overexposed to real estate. When you want to really sell it and utilize profit, you may not get the price that you want to. And which is why I think the ratio of 1 into something illiquid versus 1 into something which is liquid, both in a potentially growth asset, should be a great strategy to go forward with.
Right. Okay. So, Gaurav, how are you going to split the 100 rupees today?
So for me, being a financial planner, it's more goal oriented. I mean, if you're staying in a rented premises, instead of paying rent, you'd rather go and pick up a house and then live with the EMI, because that end of the day you're creating.
Gaurav, I was trying to work this out. Of course, this is in the case of Mumbai. If I were to pay the rent that I was paying at my current apartment for the next 25 years, I would still not pay or I would still not come close or barely come close to the current value of the property, right?
So I tell you what, when it comes
which basically means the yield is.
So I tell you what, when it comes to staying in a house where you and your family would be living, don't look at these numbers. So I'm not going probably beyond.
Sense of comfort.
Sense of comfort. You could have turbulences in your income. You could have family situations changing, ailments coming in. That's why I said, if it's for self-consumption, go and pick up a house and then live there. That's number one. And second situation we're looking at from investment perspective. So that's where you're taking a call. Will there be appreciation in the investment that I'm making? And if it's a real estate, so that's a different call. That's probably then, are you leveraging? Are you going to be borrowing, or do you have enough money? And that's where Karthik already spoke, that your real estate is an illiquid, indivisible, immovable kind of asset. So be very careful before putting in money. So that's as far as real estate is concerned. Self-consumption, go ahead and pick it up as soon as possible whenever you need to. If it's investments, take a call, but ideally that should not be your first investment, because as Karthik said, illiquid, indivisible, immovable kind. Then look at other asset classes, debt instruments. If you're looking for saving for a financial goal, which is likely to occur in next 2 to 3 years, debt is an asset class, and that will remain asset class irrespective of where the interest rates are, because equity within 2 to 3 years could be highly volatile. So then pick up a debt. Now, which instrument, that depends on your liquidity needs, in your tax bracket, etc. So those are the second.
So in the 100, if you were to divide it,
if I need a house, I'll put all in.
Okay, so house is one situation.
So that's
one. Should be driven by other considerations.
So if that's ruled out, then I'm looking at how much money do I need for my near-term goals. If I need all my money in 3 years time, put all in debt. If I don't need that money at all for next 7 to 9 years, put something for contingency, maybe 3 or 4 rupees in contingency, and rest all can go into equity. So it's purely driven on when.
So both you and Karthik seem to be fairly, consistent on the equity part. I think both of you see equity clearly as a growing or appreciating.
So for us and for me, it's more of when is your goal likely to occur. If my goal is coming 7 to 9 years away, irrespective of Sensex level, I'll always say equity. And if my goal is 2 to 3 years away, irrespective of a rate of interest are going, I'll always say debt base, and for entry make a combination of both. Nothing to do with how situation changes, because there will be cycles. In a decade, you would see 1 or 2 cycles. So don't start getting into timing market and other things. Do based on goals. and then keep rebalancing the way movement happens based on market conditions.
Right. So, and it's interesting that you say look at it almost a 10-year horizon for investing in
7 to 9 years. Usually, we say if it's a diversified portfolio, if it's direct equity, a decade, because
Right.
in a decade you'll see 1 or 2 business cycles.
Fair enough. Karthik, how do you look at this? I mean, are you also suggesting similar or proposing similar horizons for equity and debt in the way sort of Gaurav defined it?
Principally, yes. The reason even Gaurav says that, and as financial planners, we say the same thing. The reason is this, which is quite straightforward. When you have a goal which is say 5 years, 6 years, 10 years, 15 years away, you have the flexibility of allocating a small amount of money for getting that big achievement. Vis-a-vis, in life we always also have smaller term objectives, and for which you cannot go into a volatile environment, for which you have to go into fixed deposit and bond funds, and for which obviously you will need a larger allocation of your pie, which is why the longer the goal, the more the equity component for that. The shorter the goal, the lesser the equity component for that. If the goal is as less as maybe 2 or 3 years, then pretty much zero equity component, irrespective of market conditions, irrespective of country and economic conditions. So that is the principle of planning how to do investment of money. So it's like a big pocket which we are dividing into smaller pockets and putting a label on each pocket and saying what to do with it.
Right. So, Karthik, the sense I'm also getting therefore is that to a large extent we don't seem to be affected by what's happening around us. I mean, when I say what's around us, I really mean the Reserve Bank stance on interest rates, the likelihood of where inflation will go. Because what you're saying is that as an individual, you should really have your own plan, which has a far longer horizon than what may or may not happen thanks to these external or extraneous circumstances.
Absolutely. Strategically, you should have a longer term perspective, and tactically, because of some changes, for example, if the rates go down, then maybe you do a tiny bit of shift into your investment, modus operandi, if you like. For example, if there's a tax impact that comes on the way the dividends are paid out, then you maybe go to a growth option. So we can do these kind of tactical things in the short term based on external stimuli, but on the longer term basis, on when you think about life over 15, 20, 30 years, then the strategy should be broadly in one direction and you maintain that direction, and that's how you achieve most of the things that you want to.
Okay. That's a good point, Karthik. We've also got Shogata Bhattacharya of Chief Economist of Axis Bank joining us. Shogata, just a sense, we're obviously trying to drill this down to the personal level or the individual level and what the current interest and inflation sort of environment, interest rate inflation environment may have on our lives. But give us a sense from a more macro point of view, where do you see things headed, given that once again the Reserve Bank has not reduced interest rates, and what impact this might have?
Actually, I think we need to start preparing. Just hearing your previous speakers on planning investment on investment plans. I think as of now, given the information that we now know, I think it might be a good idea to start preparing in an environment where the repo rate, the policy rate, probably stays on pause for a longish time. Very difficult to figure out how inflation might move over the next 18 months, 12 months to 18 months. And you never know. I mean, that with the measures of the government and with the effect of policy rates beginning to get traction, you might actually see inflation coming down to less than the 6% in 2016 that RBI is targeting. So at that point in time, the Reserve Bank is very clear that it actually will have room to cut rates further to stimulate growth even more. So that's a possibility. But as of now, I think probability is that the way that we understand how prices will move, growth will slowly begin to increase in 2015, 2016, etc. Core inflation will begin to go up. At the same time, remember that US interest rates will also probably increase, and that will also probably have an effect on Indian interest rates. So all of these things built in together, I think the possibility is that we see a pause, that is to say, an 8% repo rate will be held for a fairly longish time.
Right. What are the other triggers that you're seeing, Shogata, from a consumer and consumption point of view? I mean, this is a sort of more macroeconomic question, which might help us understand how things are going and could go in the coming year.
You're asking specifically about consumption. Look, I think one of the corollaries, again, coming in from a macro perspective, I mean, if growth increases, we've been starved of fairly significant employment for a fairly long time. So the first thing that will happen is companies will begin to staff, demand for wages, for people, for employment will go up. As a consequence, wages will go up. If growth begins to tick up, we're probably going to see a move up, even further move up in equity markets. That will create a wealth effect. I mean, people perceiving that their wealth has gone up will begin to increase consumption demand. So, I mean, I think from a consumption, I mean, if you're looking at it from an investment perspective, I think consumption industries offer a good bet relative to the valuations and so on. But from a macro perspective, I think it is without doubt, I mean, there is very little doubt that the first move up will start from consumption and then gradually move into a balanced consumption and investment environment as and when the capex plans of companies begin to get traction, more funds come into investments and so on at that point. But the first move up will be from consumption.
Right, right. Shogata, thank you very much for joining us and sharing your views there. Gaurav, so we've got a sort of macro sense on how things might look up if they do. How should this or should it at all affect the way a consumer builds or an individual builds his or her consumption basket today?
See, if it's a necessity, so if you're going to be spending for necessity, you're not going to stop because interest rates went up or down, or because the prices of your essential commodities went up or down. So if you're going to be purchasing, you're going to be purchasing. Then the issue comes is that those splurging and luxury items, and should you be splurging or not? Now, ideal situation is that don't. I mean, as far as possible, don't, because we are seeing that instead of RBI has come to a stable interest rate. So instead of rising it, they are stable. And at some point of time, if we see growth, they will come down. So if you can hold back to your urge to splurge, then hold back and then just wait for some more time. And if things start looking more better, then go and splurge. So from consumption perspective, necessities, you don't have an option. For luxury, wait and watch.
And you're saying wait and watch because you feel that the overall economic environment is still not really.
So overall economic environment looks positive. It looks, this is again a cycle. So there could be several factors, but we have had several bad years and base effect comes in. Plus we are seeing certain corporates and companies talking good numbers. So we are seeing that growth. It's again not a full base growth that we are seeing immediately. But that has to happen because how many bad years do you see? In a decade, there has to be typically a cycle. So moment things improve, then go ahead and do it. But at this point of time, it's not very clear. So yes, there are signals, but it hasn't happened as yet and probably will happen soon.
Right. Okay, so let's now come to the point where I said that, we talked about 100 rupees today and 100 rupees now tomorrow. I think a few principles that you and Karthik both laid out, I think are well taken, that equities is the best bet if you're building a longer term horizon. Debt if you're looking at a slightly shorter term, which is say, let's say 3 years. Now, does anything else change? Can any other factor come in apart from fixed income, which in any case we're keeping, fixed assets which we're keeping aside?
What we planners keep saying is that your money requirement is more or less not as volatile. So for example, if I have to get my son married, I have to get him married. I can't say interest rates went up or went down, so just delay the marriage, right? So if that has to happen, that has to happen. So don't align your portfolio based on Sensex going up or down, or interest rates going up or down, or gold prices going up and down. You may want to kind of speculate, or you may want to trade or whatever, and that's one of the human urge, greed. You may keep aside your 5 or 7% of your portfolio and do whatever you want to. But you can't be aligning your entire portfolio based on market condition. Having said that, you may have to rebalance them. So for example, based on my financial goals, if I decided that I want 70-30, 70 equity, 30 debt, and equity markets have gone up and hence it's become 80-20, rebalance it to 70-30. That's number one. Second is when I started my journey, my son's education was a decade away. And hence I put that money into equity. Now it's 3 years away. And hence slowly start moving into debt. So realigning the portfolio should always be done. Look at your overall portfolio and asset in every quarter. Make changes every year. If there is change either in the situation of goal, it's come near term, it's kind of gone away, or if there is change because of market condition. But so changes based on market condition and goals, and not based on purely speculation. So Sensex went up, so.
Got it, yeah. Okay, Karthik, let me come to you with the same question. We are asking 100 rupees for tomorrow. How would you split it? But before you answer that, if I were to do, if I had done or adopted this approach a year ago, 10 years ago, where would I have reached with a similar basket?
Well, so I'm assuming that we're repeating the same thing, saying that 60 rupees going into equities and 40 rupees today going into non-equities without any consideration to any goal. If you're just talking about, yeah, so the 60 that I did about 10 years ago would have multiplied by about 4 times, because we technically assume in the range of about 14 to 15% is what equities would give you, or real estate as well for that matter. So my 60 would become 4 times more, and my 40% would become approximately 2 times, 2.5 times, which means I'm looking at a portfolio of 6 for the 240 and about 325. So 100 becoming about 3 times in a period of about 10 years. So this is where I would be, and then I would decide at this stage what's the best thing for me to do for the next 5 to 10 years, and then I would take it in that sense.
Right. So the 100 rupees, if we were to split today, just to recap, how would you do it? Rather, it's not today; it's about tomorrow. Sorry.
Yes, so if I take a view for the next 5 to 10 years, then I would like to, in today's time, put at least 60 to 65%. And like I qualified it, saying that if somebody is below the age of 50 or 55, then I would want to put about 60% or 65% of his money into the equity market. If he wants to do real estate, follow the ratio of 1:1, which is about 30% real estate, 30% equities, and the remaining 40s would go to non-equities, which would include a few debentures. It would include mutual fund bond products, which are obviously far more tax efficient. So that's what I would do.
Right. Okay. So last question, just to wrap up and recap. Gaurav, let me begin with you. The question was, can I afford that house? So affordability can be, looked at in many ways, including how you price your interest rate or which interest rate option you go for, floating, fixed. Should I, for instance, if I'm already owning a house, should I renegotiate my interest rates if I can, and all of that? But let's address the larger question.
So if you are staying in rented premises, yes, go ahead and pick it up. As simple as that. If you're looking from investment perspective, you may want to wait and take a call if you're going to be borrowing. If you're not going to be borrowing, if you have money, again, go ahead and pick it up.
Okay. Karthik?
Yes, I would absolutely agree. I mean, if there's no hurry to buy an investment property, maybe wait for some time, because we think that the interest rates would fall and you would get better deals on loans. And of course, if you have to do it, you do it floating rate. That's the way to go forward. If you have to buy it for your own house and you're living on a rented property, make the shift right away.
Right, gentlemen, thank you very much. I think we've got a clear sense on how you should be looking at investing or saving, but the most important thing in this is that you should have a clear longer term horizon. And when I say long term, it's really 7 to 10 years, in the words of both our financial planners and experts here, particularly if you're looking to earn and realize something from the investments that you're making. With short term, look at debt. If it's a house that you are looking at and the question that you're asking is more to do with affordability, well, sometimes you've got to take these calls without looking at all these other factors that we've talked about. On that note, thank you very much for joining us.